Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead. LME 3-month copper. The V-top over the middle of May drove this market lower in recent times, down through three important congestion zones below. The previously off-mentioned congestion zone 97.50 to 99.95, the next congestion zone between 93.95 to 96.06, most recently down through a smaller one between 91.83 to 92.56. Prices also continued lower down through the combination of 50% Fibonacci line, the July 2022 to May 2023 move, and the gold highlighted long moving average currently at 90.57. In the process of moving lower, the market exited one pattern straight into another, and then another. Originally from a bullish Andrews pitchfork into a narrow descending wedge pattern, and since the middle of June out of this and into a mid-June to early July dark blue highlighted bearish shift pitchfork. We are still within this bearish pitchfork right now, between the overhead upper time currently at 91.60 and the middle time below currently at 87.88. Prices moved below the gold long moving average into an empty zone with nothing apart from the dark blue tines until we reached the purple highlighted fairly flat extension to the upper trend line, currently 87.76 of the June to August 2023 ascending triangle, which we did so last week. This purple extension has managed to act as a base over the last week, and also this. Now, on its own, this is not that important, but it is the gateway to a whole load of congestion below dating from late last year all the way down to the 81.15 level. So it's worth noting. Now, I'd like to review a previous idea put forward 7 weeks ago, and I quote, "I'd like to put one other idea in front of you, and it is this. The whole V-top action from February to date may not be a simple V-top, but a V-top with an extension. In these types of V-tops, after the peak, the market may start moving lower, but then form a hesitation or congestion of sorts, usually a pennant or a bear flag type pattern on the way lower. This might be the case here. So I was just holding fire and writing off and retiring this pitchfork or the wedge pattern until the current move sideways sorts itself out. It could, after all, be just a hiccup in the road lower." Now that's the end of the quote. This seems to be the situation now, and the action specifically over June and early July seems to be a halfway hesitation of sorts. And that playing out gives us the opportunity to move down to the 8600 to 8700 zone, which is just about where we ended up last week. So I think we're in the last scenes of that move, and we may soon be building up action for another move or another opportunity or pattern. LME 3-month aluminium. The move higher over March, April and even May originates back in late February, with the market breaking higher from a diamond pattern type formed between late October 2023 to late February 2024. Now, please remember this pattern as we are today once again entering those levels, though obviously not the same pattern. The next feature was the big spike higher on the 15th of April that ended up as an indecisive doji cross of all things. This huge move showed some of the topside potential. In late May, the market made further new recent highs, but at the same time sowed the seeds of its own bullish destruction by making a 2-day pipe top that was also part of a larger 2-week horn top. Prices have in essence moved lower ever since, though with a small halfway hesitation in early June and an even larger one over mid-May to mid-July. The shape of the move lower was in a descending wedge pattern. It was quite narrow and very acute, and prices exited out of it in late June. I said 8 weeks ago when this started happening that I suspected we might also have a large double top pattern over April to June, and this turned out to be what happened. Prices moved down, reaching both primary and secondary targets on the downside, and in the process formed a bearish halfway hesitation over mid-May to mid-July. By late July, prices had continued their move lower enough that the downside potential for this pattern, a primary target in the 2400 zone, with a primary target in the 2300 zone and a secondary hardest reach target in the 2400 zone were also reached. The last one reached only 3 weeks ago. We are now back in the same price zone as the earlier diamond bottom pattern, roughly between 2400 to 2100. The most significant features in this area are the overhead gold long moving average, currently at 2362, and the twin neckline extensions of the pink October 2022 to May 2023 head and shoulders top, currently at 2323, and the green March to May 2023 head and shoulders top, currently at 2345, as well as congestion at 2345 and the June 2018 high at 2353. Below is what is turning out to be a super important support, the bright red neckline of the June to July 2023 reverse head and shoulders continuation pattern, and that's currently at 2228. Now, overlaying all of this is the dark blue highlighted late May to early July bearish shift pitchfork. The market has used this since early July to show the bearish angle of attack, but late last week prices exited on the upside. Now, I will keep this pattern on my daily chart for the moment. What this week has shown is that the market seems to have exited the bearish pitchfork straight into another pattern. Now, it's either an August-based ascending triangle, currently 2285 to 2333, or a late July to date based small double bottom, or it may be doing both at the same time. I'll continue to monitor the market actions, but I'd expect an outcome soon as prices exit the small ascending triangle by this coming Friday, so a result or possibly a finessing may be in order. LME 3-month lead. I said 21 weeks ago here, and I quote, "I suspect the key overhead resistance will be the same as in late January, the congestion between 2182 to 2189. End of quote. Please remember this quote, or rather remember that 2182 to 2189 level, as it will become relevant again. So the big elephant in the room, as I called it now for 14 weeks, was the mid-February to late March bullish Andrews pitchfork. In late May, the market breached the upper time, but it repaired itself, or so it seemed. But the breach allowed a bearish infection to set in that ended up being a horn top over late May, which was the high point of the recent move upwards. Moving into June now, we saw prices fall. In doing so, the market also reached the primary target for the horn top and the secondary harder to reach target. The market continued driving lower, down towards the next congestion, a wide band originating from April, between roughly 2135 to 2186. In the process of driving low, the market formed an acute narrow bear channel. 8 weeks ago, we saw prices break lower, though by the first move up to the resistance, but first moving up to the resistance band between 2213 to 2225, and even breaching it. However, the metal didn't like it up there and turned back down again towards a whole combination of supports between 2186 to 2135, which is why I highlighted at the beginning of this commentary the 2182 to 2189 congestion. This time prices punched down through it, closing below the long moving average 4 weeks ago, and into a fairly free zone below bar the congestion seen at the beginning of this year, all the way down to the combination of the congestion at 2058 and 2038, and the newly drawn dark blue highlighted middle time, currently 1959, of the late May to mid-July bearish Andrews pitchfork. From here we saw the start of 4 separate supports at 2058, 2039, 2021 and 2002 that form the next congestion band below. Last week prices pushed below these and all the way down to just short of the 2021 low, that's the year, not the price, at 1908, before turning back up higher, somewhat violently. Only the dark blue upper time, currently at 2080, managed to cap the rise yesterday. We're seeing prices drop down to around the 2000 level. From this recent action, you can see that the whole dark blue bearish Andrews pitchfork is still the dominant pattern at this time in the market, and I will utilize it so until it is broken. There are 2 other features, both bearish halfway hesitations, that I'd like you to note. The first one I mentioned 2 weeks ago, and it was the bearish halfway hesitation from mid-June to mid-July. Prices had the potential to reach down to the 2050 area, which they did 3 weeks ago. The second one is a subsequent bearish halfway hesitation from that move, a smaller one formed in late July and early August. This had bearish potential down to the 1920 level. This was achieved last week. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.